Hello, everyone. Welcome to the first of our startup fundraising series on regulation crowdfunding this evening. I'm Alex Montalbini, MS 2008. We're excited to have wide interest for today's event from North Carolina, Boston, Minnesota, Portland, Texas, and everywhere in between. Please note that today's event is for educational purposes only and should not be construed as investment advice nor endorsement.
Thanks, Alex. I'm Sheila Pruva, another co-president of the group, MSCS from Stanford. We are delighted to welcome our panelists this evening. Michael Ayrton joins us from Philadelphia. He's the president and CEO of Sterling Drive Ventures and the Rodon Group. Previously, he was president and CEO of Canex brand of popular construction toys sold in over 40 countries. Michael earned a BA in political science from Stanford and a JD from the University of Pennsylvania. He's an early investor in crowdfunding site StartEngine and regularly backs entrepreneurs on the platform. Glad to have you here, Michael.
Thank you, Sheila.
Mauricio Delgado, joining us from Dallas, Texas, is a serial entrepreneur and co-founder of Nada, a real estate technology startup making home ownership accessible and rewarding for all. He leads Nada's fundraising efforts on crowdfunding platform Republic. Mauricio has launched and sold several companies serving the Hispanic market. Previously, he was a venture capital and private equity investor. After dropping out at age 19 to start his first company, Mauricio returned to Stanford to earn a BS in computer science and an MBA. Welcome, Mauricio.
Thanks, Sheila. Happy to be here.
Johnny Price, joining us from Nashville, Tennessee, is Director of Business Development at WeFunder, a leading equity crowdfunding platform. He also serves on the Federal Reserve Board's Community Advisor Council. Originally from the United Kingdom, Johnny started his career in strategy consulting with Oliver Wyman, followed by Kiva.org, where he was Director of US Lending. He has a degree in history from the University of Cambridge and is the proud father of 3. Welcome, Johnny.
Good to be here.
So let's kick off. Johnny, could you help set the stage? What is regulation crowdfunding and how's it different from Kickstarter or Indiegogo?
Yeah, so regulation crowdfunding is a form of investment crowdfunding. So as opposed to Kickstarter or Indiegogo, which you would say are perks-based or rewards-based crowdfunding, where you're backing a project owner and it's essentially kind of pre-sales, right? And so it's revenue for that project owner, and then you get the perk in exchange for your backing the project up front. With WeFunder or other regulation crowdfunding platforms, you are investing in a company. 90% of what we do is equity investing, although we also facilitate debt investments as well, either simple loans with a fixed interest rate or revenue share-based loans where investors are getting paid back as a percentage of the revenues of the business over time. But most of what we do is equity investing. And so the current law, which actually very relevantly is going to be changing in about 45 days' time, in some really exciting ways that I'm sure we'll get into over the course of this conversation. But the current law says that startups can raise up to $1.07 million per year using the regulation crowdfunding exemption, just as they would raise capital from angel investors, but instead of raising through private solicitation of accredited investors only, through regulation crowdfunding, founders can publicly solicit. So they can tell everyone about the investment opportunity on their social media page or in the press or in an email blast to their customers. And they can raise capital from unaccredited investors as well as accredited investors. So in those 2 important ways, and probably a few more that we'll get into, we generally think that platforms like WeFunder or StartEngine or Republic are the big 3, can help to make it easier for founders to raise capital.
Okay, great. So could you walk us through the evolution of regulation crowdfunding, sort of from the Jobs Act onwards?
Yeah, absolutely. So I'll take it all the way back to the 1930s when the Securities Act basically, limited the people that could invest in early stage startups, pre-IPO startups, to being accredited investors, which for the most part, as you probably know, is rich people. That's the definition of being accredited. There are some other edge cases too, but for the most part, it's, if your assets are above a certain amount, if your income is above a certain amount, then you're accredited. So the only people that got to benefit from the wealth that was created by Uber or Google or Facebook or Amazon or these big hockey sticking IPOing tech companies, if all that wealth is being created in private, the only people that get to benefit from that are accredited investors, I guess, unaccredited investors as pension funds, as LPs and VCs. But you get the point. Like, until the Jobs Act, the ability to invest in these startups and benefit from the wealth that they were creating was limited to accredited investors. So then the Jobs Act was passed by President Obama in 2012. And this liberalized the regulations around to what extent and how startups could raise capital from the crowd, from unaccredited investors as well as accredited investors. And I don't know if we'll talk about Regulation A, but on Regulation A, with a lot more disclosure requirements, kind of similar to a mini IPO, startups can currently raise up to 50 million, soon to 75 million in the crowd. So that there are other flavors, there are other exemptions that pertain to equity crowdfunding as well. But regulation crowdfunding, was part of the Jobs Act, Title III of the Jobs Act. It took the SEC 4 years to roll out the regulations and figure out how to implement the law. They did that in May 2016. So in May 2016, May 16th, 2016, a day that will forever live in infamy in the annals of WeFunder history. That was the day when regulation crowdfunding went live for the first time. And since then, it's been growing very, very quickly as a sector, as a way for founders to raise capital. And then the last chapter of the story is that, as I mentioned earlier, on March 15th, so in less than 2 months' time now, these regulations are going to be updated and improved significantly. So right now, the most the startup raise in any given year is 1.07 million. As of March 15th, that's going to increase to 5 million through regulation crowdfunding. There are some other improvements as well. So we're about to come into a very, very exciting time of growth. The industry has already been growing. We grew about 4x WeFunder in Q4 2020 over Q4 2019. So there's a lot of underlying momentum growth. But with these new law changes that go into effect soon, I think 2021 and the years that follow are going to be very, very exciting in our sector.
Well, thanks for providing the context. So regulation crowdfunding is a two-sided marketplace. Mauricio, as a founder, what trade-offs did you consider before taking this route for fundraising?
Sure. So this was our first time issuing, in our case, Safe Notes on Republic's crowdfunding platform. Prior to this, we had raised kind of capital via the traditional routes, family offices, high net worth individuals, et cetera. When we were looking to raise capital, so that's how we raised our pre-seed capital in 2019. When we were looking to raise capital last year, going into last year, we evaluated, the pros and cons of raising on crowdfunding and via Reg CF. And we saw a lot of advantages, primarily, the ability to pick up, at this point, we launched in June of 2020, our campaign. We're up to 2,000 or so individual investors and 3,000 or so individual followers. So you pick up not just investors and their capital, but you also pick up, customers. We are a B2C company, so we're marketing to homeowners, and in our case, and so you pick up customers, you pick up brand enthusiasts, influencers, and so the ecosystem itself creates a lot of value for companies like ours. So you get the brand exposure without having to directly invest ourselves in marketing. Speaking just because we're on Republic, they have over 900,000 or so individual investors on their platform. And so we get all of that exposure. And then there's the partnership opportunities within the ecosystem. So just within alternative assets space, and specifically in real estate, which is where we're at, there's a number of companies that are following in the footsteps of these platforms, and a lot enabling the common folk, non-accredited investors, to participate in the fractionalization and in democratization of investing in startup companies and real estate and video games, et cetera. And so those advantages were compelling enough for us to go down that route. Some of the disadvantages, obviously, there's public scrutiny. You're forced to, you file with the SEC, your business plan, everything's out there. Their financials are out there. And so there's that perceived risk of, other startups or other competitors kind of stealing your strategy or your plans. But in general, the pros and cons, weighing the pros and cons, we definitely, we're very happy about, the results so far, and are very optimistic about, this year going forward for us.
Great. Michael, on the other side, what convinced you as an investor to take this route?
Yeah, I think it's been 2 or 3 key things, and I think the timing of today's thing worked out really well because we're seeing the natural evolution of democratization with what's going on with Reddit and Wall Street Bets, right? I think the whole world is trying to figure out how can they act like, as Johnny aptly put it, rich people, and take advantage of the way the private markets were being held for so long. And so I'm a big fan of democracy in general. I think of myself as a patriotic capitalist, and so by that I mean, let's give as much transparency and as much ability for startups to raise money as possible. I also, when I think about it, when I put my investor hat on, which is the role I'm sort of thinking about today, is I love to invest in marketplaces. And so the ability to invest in StartEngine itself was a compelling thesis for me, because now I don't have to worry about which one of the several hundred companies win, because they're getting, warrants in all of those companies. And so, although I've also invested in some of those companies as well, the ones that I feel have the best chances of success, I love the idea of investing in marketplaces. And so it is hard, as I think Johnny pointed out earlier, to invest in, say, eBay in the beginning, right? Or to invest in half.com before it was bought by eBay, or to invest in, Google before it became a marketplace. So, the ability to invest in marketplaces themselves, I think, was a compelling part of the story for me. And then they had visions, and they've now executed on that vision, at least at StartEngine, of allowing liquidity well before an exit. So they now have a secondary trading platform that they've just launched. And it's such a highly regulated environment, and Johnny highlighted some of the many regulations that exist. So the ability to handle those regulations creates a moat around the marketplaces that exist. So for me, all those reasons, they were just like a really compelling way to deal with startups, but also take away a fair amount of the risk.
Okay, great. Johnny, could you illuminate who can use RegCF? And what's the vetting process for investors and companies raising funds?
Yeah, so on the investor side, basically anyone can use it. I think you have to be over 18, but you can be unaccredited. I think different platforms have different minimums. I think StartEngine and WeFund are $100. I think Republic, Mauricio might know better than me, but I think it's maybe a $50 minimum. So you can, for a very little, and it's not just like you can be unaccredited as well as accredited, but one of the ways in which I think this democratization of investing is cool is that, I was chatting to an angel investor here in Nashville the other day. I'm talking to you from Nashville, where I've lived as of a few months ago. And, he had a small exit as a founder, and, he was wanting to invest 100K in startups. And I think he made about 3 investments, and all of them struggling. And then he's gone through his money, right? So being able to diversify your portfolio a little more, Michael alluded to that, I think is very valuable. So however much pool of money you have to dip your toe in the water of angel investing, if you do that on a RegCF platform, you can spread around a higher number of bets. So on the investor side, basically anyone, international investors can invest too. Weirdly, there are 3 provinces in Canada, Quebec, Alberta, and Ontario, that you can't invest from, but pretty much everywhere else is fair game. So that's on the investor side. And then the amount that you can invest each year is based on a formula. So it's 5% of your income or wealth. Currently, it's the minimum of those 2 numbers. Soon it will be the maximum of those 2 numbers. So that kind of determines how much anyone can invest in any given year. And then on the founder side, again, it's pretty open. So you have to be a US-based company. You can be an LLC or a C Corp. On WeFunder, we've had coffee shops and SaaS startups and biotech companies and movies, like LLCs that are movies and everything in between. I think StartEngine Republic also, and it's good that you have these 3 platforms represented here, because we're the 3 biggest platforms. But I think on all 3 of these platforms, there are very few kind of industry sectors that are not covered. And then in terms of stage, the range on WeFunder goes from $20,000 tiny friends and family investments and a couple of guys, working in the garage, all the way through to, with the Reg A changes, that's going to be up to 75 million. And so it, very, very early stage, all the way through to kind of Series A, Series B, and beyond.
Okay, let's compare crowdfunding to alternatives. Mauricio, how much time, effort, and cost does Orexia fundraise entail?
So relative to going down the traditional.
Relative to the angel route, I think you touch on that as well. So.
Yeah. So so this being our first time, I think from anytime you're out raising capital, it's a full-time job, and whether you're knocking down sandhill doors or launching and managing a campaign on these platforms, it is a full-time job. There are benefits of obviously centralizing and leveraging as much of your time on these platforms instead of having to go to one-on-one meetings with individual investors where your success rate is still relatively low. The fact that we're based in Dallas and not in Silicon Valley obviously was an issue, especially going with COVID and everything else hitting last year. So definitely going crowdfunding. From a timing standpoint, between you get your campaign, you go through the application process, you get your approved, you hire your lawyers, your accountants, file with the SEC, file your financials, and then launch your campaign page. Could be anywhere from kind of 3 to 6 months, depending on how quickly you've got your stuff ready to go. And then once you launch, you're out there. And so for better or worse, you start taking investments and you start taking comments, and $100 investor for us is just as important as a $100,000 investor. And we've got to be answering questions on our message board 24/7. And so that's another thing to take into account, is that it is a full-time job even after you launch. But I think once we've figured out generally the process and how it works, we'll most likely be in the market again here this year for subsequent raises, and we believe in it relative. And look, we're taking private capital too. We're not opposed to it. We've raised $1 million so far between public and private. Most of it has been on the public side. But the good thing is that we can centralize a bunch of our resources and focus by being on these platforms. And then we pick up private investors as we go through our networks. Like private side, having done it before, it is, you can go meet a seed stage fund that is in love with your product market fit and your traction or your team, and can write you a check for $1 million, and it's over and you can go execute. But it can also take months of meetings, and especially with COVID, making it even more difficult. We think we benefited quite a bit from being on Republic in this case, but crowdfunding platform in general.
Yeah, it's great to hear, Mauricio, that you'll be doing your next round on WeFunder. I'm delighted for that announcement on this panel. Just kidding. But just to pick up on something Mauricio said, I'm not sure if I heard this right, but so a couple of points on just the timing to launch a campaign. So if you're raising more than $250,000 through regulation crowdfunding, one of the most kind of significant requirements up front to launch a campaign, and Michael was kind of alluding to this earlier as well, is you need to have 2 years of GAAP financials, or if you're a startup, going back to the incorporation date of the company, that have been reviewed by an independent CPA. So review, not an audit, so it's a little bit less money, but you might pay a few $1,000s depending on how complex your finances are. But if you're a consumer-facing business and you have tons of, if you're a brewery, for example, and you have tons of revenue transactions from individual consumers, then your finances are in a mess, then that can both A, take time, and B, cost money to get that CPA review done. But that is And then if you're raising less than 250K, you still need financials. They just don't need to be signed off by an independent CPA. And so what we find on WeFunder is that usually that's a long pole in the tent. I'm not sure if that was the case for you, Mauricio, but you know, we've launched companies on WeFunder in less than a week, from first engaging with them to filing the Form C with the SEC, which then allows you to publicly promote the offering. So, or if they have financials done, then we can move very quickly. So I just wouldn't want people to listen and think, you know, the minimum time to launch a company is 3 months. And the average on WeFunder is about 6 weeks from first engagement, or at least from the founder first committing, say, okay, yeah, let's do this. Probably at that point, 6 weeks to get the financials done, put the campaign page together, finalize the terms, line up a lead investor, which we can maybe talk more about, fundraising plan, Form C, legal disclosures, all that stuff. Probably on average 6 weeks. But you know, especially if the financials are simpler, it can be expedited. And then in terms of the length of the fundraise, say the average is probably 3 or 4 months. Again, we've had companies raise a couple of $1 million in 2 days. So it can go very, very quickly if the company has a huge audience and is a really hot company. Like if Elon Musk decided he wanted to do a Reg CF campaign tomorrow, you know, he could raise $5 million in a couple of minutes. So the speed of the raise as well as the time to launch can go pretty quickly. But yeah, at WeFunder, at least average timing is about 6 weeks to launch a campaign and then 3 or 4 months to execute on it.
Great. Thanks for sharing the wider perspective, Johnny.
Can I just say one more point on the timings as well, and the requirement to launch a campaign, which is another thing that's being changed with these new laws that go live on March 15th. So testing the waters is currently not permitted in regulation crowdfunding. So this is before you file a Form C, before you do this legal paperwork with the SEC that takes time and money to put together, can you talk about an upcoming raise with, for example, your customers or on social media or wherever else you want to promote it? And currently you can't do that, but as of March 15th, you will be able to do that. And so again, that's just going to significantly, you know, accelerate the rate at which companies can start, you know, getting the word out and hopefully starting to generate expressions of interest in the campaign.
Okay, thanks. Michael, how do the costs and fees of investing on Start Engine compare, and how easy is it relative to other means of investing?
Yeah, I think it's among the easier bits of investing. I think that because of all the stuff that Mauricio and Johnny just described, that the companies are putting together these really kind of socially acceptable, I'll say almost social media type of campaigns, right? So there's a lot of what I'll call very consumer friendly ways. You meet the team, you get the business case very quickly. And so if you're not a person that wants to dive into the financials, you get a sense of the business very quickly. You don't get just these books that are always delivered everywhere else. You have these giant books and then everybody gets these books and, you know, do you really want to spend any time reading them? So I view it as sort of like Facebook, but for, you know, for investing. And I think so that makes it really easy. The fees are from the investor side are super low. Again, very, very low. So, you know, they're charging a certain amount to the companies on the platform to get going, and even those fees, you know, seem pretty low. So I think it's like, again, it's a very low barrier to entry. And in most cases, and this is starting to change as well, it's just a long time horizon until you're going to monetize your investment. Because in most cases, pre the creation of the secondary trading platform, there is no way to monetize the investment until there's some either a real IPO or other exit. So I think the addition of the secondary trading platform has now set the stage for explosive growth in this area, because if you're investing for hundreds of dollars at a time, that makes it capable for all kinds of, you know, people. It dramatically increases the pool of people. And so now it's just about, can you attract a big enough audience? And do you understand who your audience is, and can you market to that audience? So you're marketing to a very different audience from the guys on Sand Hill Road, right? You're marketing to somebody who goes, I think this is a cool idea. Yeah, here I was looking at one yesterday. Here's a mini turbine for wind energy. Are they gonna make it? I don't know. But for $500, I could take a shot at it. And if it works, I'll get 500,000 one day, and if it doesn't work, oh well. You know, and so it's those kinds of things where you can take part in these amazing ideas. What I love, frankly, about all these platforms, is you start to see the magic of entrepreneurship up close and personal in a way that I don't think you ever really see it when even when you're sitting in these other rooms, talking to the hedge fund guys or the venture capital guys or the PE guys. It's just a different level of formality that, has its advantages, but candidly, the most fun I have is doing this kind of investing. It's, you get to see the magic of America. I really do. It's crazy to me. The amount of ideas that I see every day, that you guys see every day on the platforms, where Johnny sees every, I don't know how long he's been there, but since 2012, it's less than a decade, thousands of ideas. It's amazing.
I just want to really double down and echo everything that Michael just said. That's why I work at WeFunder. I've been here for 3 years, so not as long as I've been involved with starting a ton of it. But yeah, the founders I've got to know, the companies, the ideas that they're working on, the causes. WeFunder is a public benefit corporation and a B Corp. So, we talk in our charter about, trying to fund the flying cars. Where's a flying car? Or, also I think probably Start Engine and Republic share this as well. It's like, right now, Black founders get 1% of VC capital. Female-only founder teams get less than 3% VC versus 80% male-only founder teams. I can't remember the stat. I think it's 80% of VC goes to 3 states: California, New York, and Massachusetts. So I think part of democratizing who the investors are can mean hopefully we get more capital flowing to underrepresented founders by ethnicity, gender, geography, as well as funding really cool companies and ideas that.
Okay, now our audience is extremely curious about valuation. Mauricio, could you please detail the share of ownership as a fraction of investment size? How much does a founder lose in return for a cash infusion?
So I guess I'll preface this with a disclaimer that I guess it all depends on the type of security you're issuing, because these platforms you can raise via crowd safe notes, which is what we're using, which is in essence a convertible note that converts at the next round of financing, most likely a Series A. And so in that case, the valuation is basically you're just punting it, kicking the can down the road until you get a priced round. So in our case, we have a valuation cap and we have a discount, and so the holders of these notes would convert at a priced round at the lesser, the better of, for them, a $12 million valuation or a 20% discount to the pre-money valuation that we're able to achieve. So I apologize, that's very specific to us, but there are other companies that are raising on these platforms that are raising via, priced common shares, via other securities that do have a valuation attached to them. So I guess that's, I can't speak for all the other companies that are out there, or the platforms that allow other securities, but in our case, it is a safe note, which is kind of like a convertible instrument. It's a little more founder friendly, but in essence, it's just an agreement to convert to equity at a later date.
And so what do you see as the implications of crowdfunding to your company's future valuation? How do investors view that? What's the signal?
Yeah, great question. I think that's something that we're testing waters on. Obviously, to the extent that we've been successful in raising capital at the terms that we've been raising it, I think it's a good signal to send to the private markets that, relative to other companies that have similar, risk return profiles and the terms that we're offering, that at least, the $12 million cap that we've got right now, we believe, we can go into Series A, discussions, in a few months, at a much higher valuation. That's our intent, and based on our traction, that's where we believe we'll end up. But it does, in terms of being able to send a signal to the market that there's at least a few thousand investors that believe in your product market fit and your traction so far, and are willing to invest over $1 million in your company at these terms. I think we believe it's a strong signal for to increase the valuation, either if we do another Reg CF campaign, if we do a Reg A campaign that we're also thinking about, or if we go down the traditional route of Series A.
Yeah, I look at it just as to follow up on Mauricio for a second. I would say I look at it as a tremendous opportunity for the companies that do this kind of fundraising to create owners who are evangelists for them, that they don't have to pay. In fact, they've gotten paid by them to own part of the company. So to the extent they're able to create that audience and have that audience talk for them, they've now developed their own network effect that you could never do by getting $1 million check from somebody, unless that person happened to be Kylie Jenner, and then she's willing to go Instagram about it. But that, you know, other than those kinds of weird one-offs, now you've already got several thousand people who, if you're effective at communicating to those people, I think that's going to be the next part of the job. And that's what I've been seeing. I've been doing this since 2017. So as I've been watching the companies, what I think are the more successful ones are the ones that are communicating well with their investors. And they're finding ways to copy, I would say, a little bit from Indiegogo. So they'll create perks if they're selling products so that they can have that also seeded out there. They're using them as test kitchens for new products or ideas. So it's a tremendous, I mean, you're getting a free focus group that actually invested in you, and you can still do stuff with them. So I think those companies that think about it that way are going to be the ones that leapfrog, you know, and may not even need to tap the traditional Series A world ever again. But barring if the cap of 75 million gets to be too much, if that's your biggest problem, God bless you. But I mean, for most people are pretty happy at raising tens of millions of dollars, have a nice life, a nice investment, and they're moving on, you know, and they're generating enough capital in their own business so they don't need more financing. Because being a public company is a pain in the butt, super expensive, and you think you're getting scrutiny now. Right now, you got fans. Public companies, you know, all you got is people gunning for you. So I think it's just a tremendous, that asset for people, having those evangelist investors is something that you don't really ever see, even rarely in the public space. Maybe you see it with a company like Tesla where the people are super fans, and you know, but you know, how many super fans of 3M are there?
Right.
I might just paint a quick counter narrative, just to a slight extent. You know, for me, if a VC is considering investing in you in a Series A, right, there's a ton of factors that they're looking at, right? Team, growth. And one of those factors is, you know, who's on your cap table, right? And so I think most VCs would probably rather that, you know, there's like some blue chip, like, you know, early investor, like institutional investor in your seed round versus, you know, having raised on a platform like Republic, Style Engine or WeFund. I think over time that will change. I think probably some of that is just perception versus reality. So if you wind the clock back to 2016, I think all three platforms couldn't roll individual investors in the regulation crowdfunding round up to one line on the cap table. So Republic might have put 2,000 individual investors on Mauricio's cap table, which that is like an actual problem that, okay, if a later stage investor, you know, has some qualms about that, fair enough. But now I think all of the major platforms, through various different mechanisms, whether a crowd safe on Republic or a custodian structure on Style Engine and WeFund, we roll individual investors up, so it's one line on the cap table, right? And so any kind of practical concerns that a follow-on investor might have are basically mitigated. And then it tends to, and I couldn't agree more with what Michael said, you know, my argument, and I'm biased, obviously working on the BD team for WeFund, but my argument will be if Mauricio recruits 2,000 champions, you know, brand ambassadors for NADA, customers, you know, enthusiastic owners, they're proud owners of the company. Hopefully now he can leverage that and put them to work to help him grow the brand. That will generate the growth curve that is much, much more important to an investor in the next round than, you know, whether your seed round was done by, you know, some VC or raised from your community of fans.
And Johnny, with your perspective into a wider data set, could you chime in on the investment size against ownership sacrifice?
Yeah, I mean, I agree with Mauricio. It really depends, right? Obviously, the smaller the better from a founder's perspective. And you know, we've had Modern Times, I forget the exact numbers, but they raised $1 million with us. A brewery in San Diego raised $1 million with us in 4 days. I think their valuation was over 100 million. They were doing, you know, tens of millions of dollars of revenue a year. So for them, they gave up 1%, right? And then we have very, very early stage companies who might give up 20%, kind of or similar. And I think one thing, this is a meta principle that I think is worth people keeping in mind. One thing I like to advise to founders that are exploring using WeFunder is see a regulation crowdfunding campaign as behaving similarly to if you were to raise from angels, right? So keep having those in-person meetings. Mauricio has probably had a bunch of meetings with accredited investors, angel investors that can write him 25K checks. If you have those come in at the start of your crowdfunding campaign, then when you get in front of the crowd, the conversion rate and the ROAS on, you know, any marketing efforts that you do is going to be higher because you've raised more dollars from serious investors at the start of the campaign, right? Same thing on valuation, right? If you would be pitching angels or early VCs on, you know, a safe note with a 5 million valuation cap, if you try to launch on Start Engine or WeFunder with an 8 million cap, then it's going to be tougher for you to raise. And if we've seen an elasticity of demand from investors where, you know, we might warn founders and we're going to veto it if it's super out of market, but as long as it's within reasonable bounds, at the end of the day, we're going to defer to the founder and say, you're a grown up and you can, you know, we'll give you advice. We'll encourage you to, you know, line up checks from investors at the start of the process to validate the valuation. But I've told founders in the past, your valuation's too high, and then they've gone and struggled to raise some money and raised less than they could have. So there's obviously an elasticity there, and there's a bunch of different ways you can try to ensure that you launch with both terms where we do safes, convertible notes, price rounds on WeFunder, the valuation cap, the discount rate are in the right ballpark. We also, like I mentioned before, we've done revenue shares. One of the things I think is cool about regulation crowdfunding as a sector is that VC and kind of the standard path that's kind of fetishized right now is so homogenous, right? There's this movement around revenue-based financing. I was chatting to this guy on our podcast the other day who has this revenue-based financing fund. He said that his founder at the fund was doing 3 million in ARR, growing at 30 or 40% a year, and couldn't raise equity capital to take the business to the next level because the TAM was too small. Like, that is so insane that a company like that cannot figure out, you know, somewhere in the middle of bank loans and VC. And so for me, one of the cool things about a more democratic kind of open approach to raising capital is that alternative investment structures, like look at the indie VC stuff, or Earnest Capital's seal note, or in our case, revenue share financing. You know, basically what we need to try to do is find an investment structure that's going to both work for you, for the founder, you know, but also work for investors as well. And that doesn't necessarily need to be, you know, a convertible note or a price round, or even equity financing at all.
So on the note of investors, Michael, what numbers do you look for when you decide to invest in a particular company? What type of returns do you expect and when?
So the returns that I expect are much longer term. I mean, but before the trading platform was put on, I assumed it was going to be best case 5 years, more likely 7 to 10 years before we would see any return. I'm hopeful, you know, my internal analysis is that I'm hopeful it's double on an annualized basis, the you know, the S&P return. So I'm hoping for 20% annualized returns is what I'm targeting. When I'm looking at companies, my filter is, are they really platform companies? Are they potentially marketplace companies? Or do they have some protectable position? And so for me, that means I tend to shy away from a lot of the, you know, just pure marketing branded plays, because you can lose a lot of money in marketing. So while some of these vodka brands and tequila brands may end up doing great, they're not for me, because I feel like if Constellation Brands want to put them out of business tomorrow, they can. So I'm looking for things that are in a niche of a market or a total market itself. I care less about the total addressable market that Johnny talked about, because I agree, if you have a really solid, good business that can throw off a lot of cash, I'm happy whether or not, you know, the entire universe is your potential customer. So that's what I'm looking for. And then in terms of what have they done so far, I'm usually looking for something a little bit beyond you know, the early stage. So I want to see some customer base, some history of sales, you know, at least for me, at least 2 years of run rate and some growth in that. And there are companies that have less than that, but you know, the people have invested in, but that's what I do. Those are my main filters for that. And in terms of just tying up Johnny's thing about, you know, how should the founders look at what dilution to give up? I sum it all up as pigs get fat and hogs get slaughtered. And so if you figure out, you know, what seems fair, ask a few of your friends what seems fair, you're probably in the range, and you'll do fine. And I think taking the advice of the people who run the platforms is an important data point, because they're seeing hundreds of campaigns and they see the ones that work and which don't. So I think that's a nice, you know, I'm not privy to when that happens, but I think to the extent that people on this call are potentially thinking about crowdfunding, you know, you've got experts, take their advice.
Okay, great. So now we're moving into our lightning round so we can get to live Q&A. Johnny, what are synergies between raising rounds on RegCF and other channels, for example, accelerators?
Yeah, I mean, I would say they're pretty independent. A small synergy is that, you know, if you went through Y Combinator, then firstly, that's an awesome like logo to have in your resume and put that front and center in your WeFunder campaign, right? And then secondly, if you can persuade the accelerator then to, you know, promote your campaign to their alumni founders or their email list, if they, I mean, they're investors in you, right? They're incentivized to help you succeed. Right now, the thing you need help with is closing your financing round quickly. So they're kind of incentivized to help you promote the offering. So if you can get accelerators to help you with the marketing of the campaign, I think that's one clear synergy.
Okay. Mauricio, what are key considerations when you decided to go with Republic among the other RegCF platforms? I'm sure Johnny is intent on hearing your answer to this.
Yeah, he hadn't met me yet, that's why.
In our case, it was somewhat serendipitous that we ended up with Republic. We had a connection within Republic. I also know that Ryan from Seed Invest, but unfortunately at that point we didn't know anyone from WeFunder or Start Engine. And so when we decided on Republic, you know, I think company platform fit definitely is something, you know, all these companies should be looking at. In other words, like how many other similar companies to you have been have successfully raised on these platforms? You know, obviously like number of investors and average investment size. You know, I think the top three will kind of check the box in terms of, I know Republic's kind of close to 1 million investors on their platform. I think the other ones are in the park as well. You know, how much press, promotional network access to kind of the ecosystem that they have. You know, looking at prior raises, seeing how many other companies have continued growing. You know, if you see a bunch of broken website links, you know, that might signal that, you know, some of these companies weren't as obviously successful, you know, as initially they may have looked when they were being evaluated for these platforms. But yeah, I think those were kind of the key considerations we were looking at when we chose Republic. And now, you know, now that we have, you know, we've been successfully raising on that platform. Now we're, you know, love to have a conversation with WeFunder and Start Engine as well to you know, to evaluate future raises.
So it sounds like you're saying a big signal for you is the quality of the other firms raising on the particular platform. So on that, yeah. So on that note, Michael, what do you consider red flags of companies you see on these platforms?
Yeah, I think for me, it's less red flags than more that what the kinds of investments that I think, when I'm thinking about it really as being the owner of the business. And so is it a business that I think has a future that is protectable, has a plan, has a team that has some experience that makes me think they can do what they say they're going to do, and is it something that I can understand? For example, one that I passed on, which was raised at I think $8 million on Start Engine, was about some engine that sounds really cool, and I thought it was really cool, but I have no idea if it really ever work. And so I say, it's just not for me. And I'm guessing that many of the people who invested in it are like all really smart Stanford engineers who, you know, understand that concept. So I picked, recently invested in an app that's about discounting, collating of discounts. And what I like about that is it's a potential for a network effect. I think it's called Fluzz. So Fluzz is taking advantage of a huge addressable market, has a lot of partnerships with retail already, including Target and Gap and others. And so that's one that makes sense to me because I understand how it works. I know people like to save money, and they've got a team that's done similar kinds of things and an algorithm that seems to work. So there's one that I like. There's another one that I recently invested in. I think that's going to do a private jet startup. It's very risky, super risky, but the team has been involved in the jet industry for 30 years. They bought some planes, and they're going to go for it. I think it's cool, and I understand how to get on a private jet, why people want it, especially in the age of the pandemic, how that's been highlighted. So those are the things. So the red flags for me are more about what I think the opportunity for the business is, and if it hasn't had at least a couple of years history that I can look at. And if it looks like because they do present the financials, if it looks like the financials aren't presented in a transparent way to me, then I'll pass. But I don't find a lot of that, candidly, so far on the platform. I think, that I haven't seen a lot of that. Maybe Johnny has. I'm sure I've looked at less deals than him. But I think most people are going at it trying to not pull anything over on anybody. They're trying to just pursue their idea, and this is their path forward.
Okay, great. So now it's time for the live audience Q&A. Audience members, you may use the Q&A box or the raise hand feature to ask questions for the panelists, and we already have some. So we have a question for Johnny. This is around what are the maximums any individual can invest in annually? Could you please repeat that? Because I think you broke up then.
So it's kind of a complicated formula. It's like a percentage of your income and wealth. In that link I sent, you can kind of go and read the specific rules. The maximum that anyone can invest right now is $107,000, even if you're accredited, which makes zero sense because accredited investors can invest unlimited in Reg D, but they're limited at 107K in Reg CF, which doesn't make any sense. That's one of the things that's changing with these new rules being rolled out on March 15th, is that following March 15th, accredited investors are going to be able to invest an unlimited amount in Reg CF as well as they can in Reg D. So these rules are changing a little bit. It's a basic formula, but most of the platforms, like if you trigger, like on WeFund, if you trigger that limit, if you try to invest more than 20K, say, we might ask you, okay, what's your income and wealth? And it's self-reported usually up to a certain amount. So most of the platforms make it pretty easy for you to figure out how much you can invest.
Okay, great. And it looks like we have another question, which might have also been answered in the chat, but in case someone didn't catch that, the question from John is, how realistic is it to try to raise capital from a specific existing community, for example, parents with certain age children for a kid's educational program?
I mean, from the investor perspective, I think that if you have a business case and you have the ability to persuade in the business case, then I think these platforms are perfect for any kinds of those ideas. So I think if you're segmenting to a particular market, it sounds like it's in the kids space. So at the time when I was running Connects, right, we were selling, a physical building tour from kids of preschool, basically to age 12. And then we had an education segment where we segmented selling to teachers to do STEM learning in schools. So depending on what this is, you have to just understand who your audience is and then create the case. I think it's, I don't know if Johnny has a different spin on that, but when you're saying
I was being quiet because I answered the question. I wrote an answer to the question before, but for me, if you're marketing, if you have a certain target customer demographic as a company that you're selling to, yeah, absolutely. If you can market the campaign to those people, not only are they probably going to be more likely to invest in you, so you'll have a higher return on that marketing effort, but also when they invest, they'll be your customers as well. So, whether you can raise exclusively from the narrow target demographic is probably dependent on how big that population set is, right? And obviously, like the more affluent, if you're like selling, yachts and private jets, then probably your target customer demographic have a lot of money that they can, you know, use to write you 5-figure checks. So obviously, like how rich your target customer demographic is plays into that as well. But I think that's a brilliant marketing strategy, right? And to at least to start with, on trying to raise capital from the people who are your ideal target customer set.
Okay, next question. From an attendee, I see a lot of small investments of around $100. What type of return can this investor realistically expect, especially with dilution over multiple future fundraisers?
I mean, I can answer that. For me, I wouldn't think about the dollar amount. I think about in terms of percentages, right? So Jason Calacanis invested 25K in Uber. He made 125 million in the IPO. That's a 5,000% return, right? Or sorry, 5,000x return. You know, so what's that? $100 goes to 5 million, I think. I might be doing the math wrong. Maybe it's 100 goes to 500 grand. But you know, so the percent, and obviously crazy out there, but for me, it's like percentage, right, is the important thing. And so for someone, if $100 for them is quite meaningful, then give them the opportunity to earn a percentage on that is what we're about. And the other thing for me, and Michael's comments were alluding to this, obviously we hope that investors are making money on WeFunder, but investing in startups is super risky. It's illiquid, you know, it's locked up for many years usually. Maybe there'll be more and more secondary demand over time, but probably pretty illiquid secondary market right now. And so, you know, for us, our tagline is invest in startups you love. So ideally, you know, sure, you're investing to make a return, but as well, like invest in founders who you believe in or causes you care about, as well as thinking about the financial returns.
Okay, next question. Are there examples of companies that have realized an exit for investors already through these platforms?
I should probably go again there because I probably have more data than the other guys. Sorry to not like.
No, of course.
So we've had a couple of smaller exits on WeFunder. I mean, we made the first RegCF investments in 2016, and they were, you know, a very small trickle of campaigns at that stage. So in terms of exits, we're pretty early in the journey. We were doing Reg B investments since 2012, 2013 when we went through YC. And so there have been a few more exits there, but obviously the really exciting potential exits, like Beta Bionics, raised on WeFunder in 2016, making an artificial pancreas. You know, they just closed the 56 million Series B. So obviously the really exciting ones are, you know, further down. I did get some exciting news about a startup that raised last year on a 40 million valuation, where there's at least a decent chance of a 10x exit in 1 year, which would be pretty amazing. But those are relatively few and far between, you know, as the lifetime of companies that have been on WeFunder grows. And I'm sure this is the same with Republican Start Engine and other platforms as well. There's probably like 50 RegCF platforms. These three are the biggest ones. And then there's exits like, you know, with revenue share or loans, then the exit is getting paid back on your loan. So obviously there's a little more kind of short-term liquidity and payback on the debt side.
Okay, thanks for sharing that, Johnny. Now, crowdfunding seems to start with projects and then move more recently into startups. The audience member asked, for projects, many of them never delivered on their initial promises. So they took in money and ran sort of away, which makes potential startup investors concerned about legal obligations of startups. Do they have to spend money on furthering the cause put forth in their campaign as part of your platform requirements, and how is that enforced?
I'm not going to, I mean, obviously I'm not going to speak for Start Engine, but I will say that, and for part of this, it's a highly regulated investment. So if you read into the fine print of the investment you're making, it'll give you a sense of what the requirements are. But generally, again, I try to keep it super simple. Go in assuming you could lose all your money, and then you'll, you know, that, because I think somewhere in there they essentially have to say that anyway. Because once you list all the risks, it basically says you should, you know, you're an idiot for doing this, but please do it anyway. So That's really what it is. So, this is, if you're thinking about allocating capital and you're an investor, whether you have $100,000, $10 or $1 million or more, it's, I think you shouldn't be spending more than 5 or 10% of your capital for investing in this area. Like, this is the most fun part of what you should be doing. It's better than going to the casino, but it is, you're taking a real flyer here. You're talking in best case, with the one example, exception that Johnny said was maybe 2 years we get an exit. Most exits are 7 to 10 years. I mean, many people probably on this phone call know this, or on the Zoom call know this, but even within private equity, which are allegedly all sophisticated investors, only about 35% of those are successful. So, assume you're going to have the same. If you're very fortunate, we're going to have the same hit rate here. 35% are going to do great. I think it's going to be lower than that, but I hope I'm wrong. But I think going in, just that has to be your mindset. That I may never see this money again, but if I do, it's going to be a whole lot more than I put in as a percentage. I agree with Johnny on that. If $100 is meaningful to you, then maybe you'll end up making 10,000. But you can't make $1 million generally unless you invest a substantial amount, with the weird exception of today in GameStop. Other than that,
Yeah, just to build on that, like, it's kind of scary. Like, probably about 50% of WeFunder investors have made one investment. I imagine that's probably pretty similar on starting.
Yep.
Repeat investments with us account for about a third. It depends on the campaign, but a third of it. So that's actually a very helpful expectation set as well. I'm not sure what this was, Mauricio, but if you're looking to raise 300K on WeFunder as a pre-seed, then you might expect to bring 200K from angels, friends and family, your customers, emails to LinkedIn connections, anyone listening to this call that you're pitching can come in and invest, right? I guess Mauricio's live, so you should go to Natter and check out his campaign and invest in him. I'm going to on Republic. But you might bring 200K from your marketing, and then the WeFunder investment might be expected to bring 100K. But the point is that 50% of WeFunder investors just made one investment, and if the majority of startups invest to zero, which is the same for like the best VCs in the world, right? Like, all the returns are in the power law companies that return the whole fund, right? And the majority are probably getting to zero, even for later rounds, and so. That means that the majority of investors on WeFunder are probably, their investment is going to go to zero, which is someone that spent the last 7 years working at a non-profit Kiva on financial inclusion is kind of scary to me. And one of the reasons we try to be very explicit in flagging the risks and, invest in startups you love rather than, invest your $100 one investment in the hope of making an 8% return.
Okay, now I'm going to ask Oscar to ask his question live. Let's see whether this works. Oscar?
I was muted before, so I apologize if you could hear me typing or anything. I was curious for Mauricio, when you apply, and I don't know if campaign is the right word, but as you generate your page, what level of investment does that take from you? When I think about some of the comparisons early on with Indiegogo, Kickstarter, and clearly understand the difference there, but they typically have a kind of a fancy video, some nice marketing shots. Like, what all went into the effort on your end?
Yeah, thanks for the question, Oscar. We, because we were accepted and we started developing all of our materials literally when COVID hit, and I think that's the other reason why it took us a couple more months than usual to launch. But we basically did it all ourselves. I mean, all the copy for the page is ours. For better or worse, I've spent part of my career doing pitch decks and reviewing pitch decks and building them, and so that was generally somewhat natural for me. And then it depends on the product or the type of company that you're pitching, or if it's something complicated that would require videos or demos or something like that. In our case, we just shot the video ourselves of us talking about the opportunity. The graphics we did in-house, and so it was very minimum investment from our standpoint in terms of putting the campaign page together. the biggest costs for us were lead and the financial review, and those were relatively minor as well.
Okay, we have another question. Could you please compare regulation crowdfunding to GUST, and including some examples of companies that didn't make enough to pay, for example, the start engine fees?
I can jump in here. I'm trying to, again, not speak too much, sorry. So GUST, as I understand it, is kind of mostly around incorporation, or GUST launches around incorporation. I don't know the other product offerings that GUST has. So certainly GUST launch would be different. And on WeFunder, I think that the startup fees, I think, depend on the platform. I'm not sure exactly what the latest on Start Engine Republic is. Michael and Mauricio can speak to that. On WeFunder, we don't charge any fees to launch a campaign. So we just charge you a percentage of the amount that you raise. And if you fail to meet your minimum goal, and I think most platforms, you set a minimum, which might only be 50K, and then a maximum, let's say it's 500K. And as long as you pass the minimum, you keep what you raise. And on WeFunder, if you miss your minimum goal, so you don't get anything, then we don't actually make any revenue on that.
Yeah, all of our fees are back-ended with Republic. It's basically based on the capital we raise, and then they just take it out at the end.
Yeah, from memory, Start Engine does have a $5,000 fee, I believe, to get going, and then the rest is all back-ended as a percentage of the raise, and I think still a 2% warrant on every deal.
Thank you. Katie Kavanaugh, did you have a question you'd like to ask?
Sure. Thank you, gentlemen. Great information. So I have been talking with Start Engine, and the woman I spoke with, who speaks incredibly rapidly but incredibly clearly, and you probably know who I'm talking about without using her name, she spoke about that more is expected from the community already built at Start Engine rather than friends and family. Can you speak to that?
When you say more is expected, what do you mean?
I would say the funding would be coming from the community rather than friends and family.
Yes, that is the Start Engine model. I think that they have a different view slightly than Johnny expressed about the relative value. So, but the Start Engine philosophy, at least as I understand it, is more around, here's what we think your campaign can do, and if you have stuff coming from other sources, that's great. And certainly the ability to sort of, for those of us who have been to charity auctions, you know how this works, to have a few people bid first always gets the momentum going. So I still think that's a good tactic, whether that's part of this or part of anything else you're doing. But yeah, Start Engine looks at them, sort of their services in a vacuum from whatever else you're raising. So as you think about the raising with them, they believe the community, if you can do the kinds of things you say you can do, that you can hit your goals. So it's, I think they're just not looking at it on a relative basis on where else you may be raising capital from, as much as, and I'm not saying WeFunder does that. I think Johnny's just expressing the statistics of what's happening, as opposed to the way WeFunder would also look at it the same way. On WeFunder, they're probably gonna look at what WeFunder can bring. Just don't assume it's 100% of what you might need.
Yeah, exactly. Across the $200 million we've raised, about 2/3 of that has come from first-time investors, and then 1/3 has come from repeat investors, which is what I was getting at. And I just answered the question as well in writing. But we've seen Y Combinator companies, they're going to be very attractive to WeFunder's existing investor base. So on average, across the, dozen or so YC companies we've had do a Reg CF campaign with us, about 75% of their capital is coming from existing WeFunder investors. So they have to work less hard, I guess, to get the ball rolling on the campaign, because that's going to be very, very exciting to the WeFunder investors to make those live. And then, Modern Times, the company I mentioned before, the brewery in San Diego, or Chattanooga FC was a soccer club in Chattanooga that raised 900 grand with us. And basically 100% of their investors were, people living in Chattanooga that they brought, who were not previously WeFunder investors. heard about the campaign to their marketing and invested. So it does vary wildly between campaigns.
Yeah, one of the things that Catherine, that is, as you may be thinking about where to launch, and I was thinking about this when Mauricio was talking about, as he's saying, I want to be sort of associated with other companies on a network. And I realize a lot of things have sort of come together. It's 10 years of crowdfunding, roughly. It's 10 years of Shark Tank, roughly, on the air. And weirdly, the merging of those two worlds, right? Kevin O'Leary is now the spokesperson for Start Engine. And so that may be an X factor for companies that say, hey, everybody knows Kevin O'Leary, maybe that gives me a halo effect to my campaign. So just as you think about the platforms, that could be because those kinds of audience building that he's already done, that you're sort of drafting off of, I think we'll see if it pans out. It's early days of him being the spokesperson, but it is an interesting thing that I've noticed, those two worlds coming together.
Okay. Well, a final question for the panelist. What's your ask from the audience? And we will start with Michael.
Well, my ask is that to always think about the world as an investor. And so where you want to spend both your time, which is your most precious resource, and then your resources. And I love WeFunder's tagline of invest in the companies you love, because we're helping each other. We're all in it together. So I encourage you to take 5 to 10% of your investable capital and put it in platforms like this and support what I think is the future of investing. I think the quote dumb money is going to be the smart money, and that's where it's going.
Okay. Mauricio, how about you? What's your ask from the audience?
Okay, so other than going to our campaign page and investing in our company, so we have an opportunity for non-accredited investors, for accredited investors via via Reg D that we've got as well. So if there are any individuals that would be looking to invest, more than $25,000, there's an opportunity there. But beyond that, philosophically, I'm completely in agreement with Michael and obviously Johnny in terms of the future of democratization of capital, fractionalization of assets that allows for individual investors to buy $100 of whatever, racehorses, startups, vintage art. We're seeing it across the space. We're doing it in real estate, and we're very excited about the opportunity to fractionalize and unlock homeowner equity within residential real estate. And we think that there's opportunities to partner with platforms like the ones on the panel to do that. And so and then to Michael's point, we actually do believe going retail and then institutional, if anything, there's opportunities where we can flip. We can go retail first and then flip it to institutional once we prove out the model with retail investors and make retail investors a lot of money along the way too. So.
And Johnny, what's your ask from the audience?
Yeah, so on both sides of the marketplace, if you want to check out investment opportunities on WeFunder, you can be an investor, in a few minutes for $100 if you find it you think it's cool. WeFunder.com, and then you can explore, and we have 150 companies live right now. And then if you know any founders, or if you are a founder that's looking at raising, please do consider WeFunder as the way to do that. I'm Johnny at WeFunder.com, or you can find me on LinkedIn, and we'd love to chat with you and try to persuade you on using WeFunder versus Start Engine or Republic.
Okay, well, thanks very much, gentlemen, Johnny, Mauricio, Michael. It's been an absolute pleasure. Thanks very much to our audience for joining today and participating in this very engaging discussion on regulation crowdfunding.